welcome to the third lecture on the third week. Yeah. So, we are essentially into option pricing, and we are today supposed to look into the single period model, where the price here was S0, and then you had two possibilities of the price at time t equal to 1. And of course, you have bought an option with a strike price k, and you want to know what is the price of that option that you can charge, right. So, all those things have been completely discussed. I would just remind you that in our analysis here, the market is complete. This means we will assume that once you take the option price, the money, and then invest it in the market, and the worth of your portfolio at time 1 is same as the worth of the option. That is exactly the main idea behind the completeness of the market, where the things can be perfectly hedged, the risk that you are exposed to can be perfectly covered. So, suppose I take somebody, so V0 is the money charged for the option. Well, we will have to find it in terms of the other data available, which is this. What is the data available? U, D, R and S0. So, let this be the money charged for the option. Okay. So, what you do? You take that money, part of it you buy some delta naught amount of shares of the given stock. This is a market with one stock and one bond actually, basically, or one stock and one money market. So, one stock, our market is a very simplistic market, one stock plus money market. Now, so you have charged this money. So, with this money, a part of this money, you buy delta naught amount of shares of the stock. So, you buy delta naught amount of the shares of the stock at price S0, and the remaining money, which is your so we will not put V0 at this moment. V0 would be finally the worth of the portfolio. So, I assume that I start with some money x naught. So, let us not bother about that V0 has to be charged. V0 is the money that will be charged. This is that we have to find out. So, suppose this is just for you to, I can use V0 also, does not matter, it will come out to the same. So, what I am trying to find is the worth of my portfolio at time 0, or what I am doing, suppose I have got x naught amount of money. So, in x naught amount of money, which is same as your V0, that is essentially what I am trying to say. I am, instead of writing V0, let me just put x0. So, V0 is something I do not know, but suppose if I had x naught amount of money, then what I would have done? I would have bought some shares and invested the rest of the money, right, in the money market. So, what is that? So, if I invest the rest of the money in the money market, means this is the amount of, so delta naught S naught is the amount of money I have spent, and then remaining part of this x naught, that is x naught minus delta naught x naught, these I invest in the money market. It does not matter, you can write V naught also. So, I am writing x naught because x naught could be any amount of wealth, it does not necessarily mean V naught. V naught is the option price, we will at the end put V naught equal to x naught, but here just I want to show that if you start with any wealth x naught, At time t equal to 0, this is what you do, because as we have already said in the previous discussions, no investor should ever put money only in risky asset, but should divide the thing between the risky asset and the non-risky asset. So, what is the wealth of my portfolio at time t equal to 1? Of course, the wealth that I have depends on whether it is head or tail. So, that is a random variable. So, at time t equal to 1, my wealth of the portfolio is this. What I will do, I will sell these delta naught shares that I am holding in the market at price S1, which could be S1t, S1h. X1 here is a function, it is X1 of something, t or h. We will explicitly write this. So, you will sell the delta naught plus the money that you have invested in the money market with interest rate R, which is given to you from the last lecture. Of course, let us, as you please do not forget that we are always using the no arbitrage condition. This I do not want to write, but this I am just writing to remind you that you cannot escape the no arbitrage condition. So, because we want to get a price of the option which is free of arbitrage. So, at time t equal to 1, my wealth now is, so the worth of my portfolio is this. If you are reminded of what we have done in the part 1, for those who have done part 1, we have already done this sort of things in a continuous time, but we will come to them at a later stage also. But here I am doing for those who have not done that course, so everything can be done in a very simplistic fashion, but still has a huge practical importance. Okay, you could write this thing possibly in a more compact fashion. Basically separating x naught and this s thing. This is something. So, what should be the initial wealth I should start with? So, if I am in the option market and if I have sold the option, my x naught should be equal to v naught. And what is the meaning of replication? That x1 of h should be equal to v1 of h. The worth of my portfolio, if h comes, should be v1 of h. Worth of the option when you have head coming, and you see it is a backward thing. You first know this and then go to this. It is like something like dynamic programming. If you have done some dynamic programming, x 1t should be equal to v1t. These are the conditions that should be satisfied. So, I now know this. So, I can separately write these two conditions, from there infer what is x naught. So, I will just rub this part and then I will let you know, or rather write down for you explicitly these things. So, I can write in the first case x naught plus, just writing it down from the book so that you check the calculation. So, this is one when h occurs. So, what it gives it, by dividing by 1 plus r, we have got a discounted price or worth of the option at time t equal to 0, at time t equal to 1. So, At time t equal to 0, this is the discounted worth of the option. Basically dividing by 1 plus r on both sides. That. So, the second equation, it looks the same, only h is now replaced with t. So, this is exactly these two facts. So, now multiply the upper part, multiply this equation by some number p naught and multiply this equation by some number q naught, q tilde, such that p tilde plus q tilde is 1. So, you multiply this by this, multiply this by q tilde and see what happens. If we do so, then finally let us see what we get. So, if I multiply them, we will show you why we are doing so. So, these are two quantities such that they sum up to 1. You might think, oh, they looks like probabilities. Of course, these are two unknown quantities and we have not, you cannot say it is probabilities because we have not said whether p tilde and q tilde is greater than or equal to 0. We said just two quantities who add up to 1, we will multiply this first term by p tilde, second term by q tilde. So, finally we would have, and then add these two things. So, finally we would have x naught plus delta naught 1 plus r p tilde S1H plus q tilde S1T minus S naught. You know, when you add here p tilde x naught plus q tilde x naught, you become p tilde plus q tilde x naught, which is x naught, and this becomes 1 by r p tilde V1H plus q tilde V1T. So, okay, it does not matter, you can take possibly any p tilde q tilde you think, but no, here we will make a unique choice, we will make a very different sort of choice. What is that choice? We shall choose p tilde q tilde in such a way we shall choose p tilde and q tilde in such a way this p tilde and q tilde are different from p and q equal to 1 minus p, by which the coins are tossed, p with head and q with the probability of tail. They are different, in general different from p tilde and q tilde, such that this quantity vanishes. So, I am using them to solve these two equations basically and find my v naught base. So, because x naught is equal to v naught, if I put these to be 0, then my v naught is nothing but this thing, that is all. It is a convex combination of V1H and V1T divided by 1 plus r, the discounted convex combination. So, that is essentially Black-Scholes price actually. So, x naught, S naught, so we assume P is such that S naught is nothing but 1 by 1 plus r P tilde S1H plus Q tilde S1T. We will discuss more about the nature of P tilde and Q tilde, and they would have a name which we will soon call them. So, this would immediately show from the above equation the following. This will immediately show me that this would imply that x naught now is equal to 1 plus r p tilde V1H plus q tilde V1T. So, I have uttered the term convex combination while speaking about this. I have also uttered the term that they should behave like some probability, that is what is our inner wish. So, p tilde q tilde should be equal to 0, but then I should be able to find p tilde and q tilde. I cannot just say that okay, p tilde and q tilde is some number and p tilde and q tilde should be computed through the data of the problem, which is u, d and r, that is all. That is an S naught. So, p tilde and q tilde one should be able to compute it, right. So, once you know x naught is equal to V naught. So, this means that V naught is also equal to this, so option price is this. Now, I should be able to know what is p tilde and q tilde in terms of this, and then from there you will see we will deduce that p tilde q tilde are indeed greater than equal to 0. So, from this equation I have S0 equal to 1 by 1 plus r p tilde S1H plus q tilde, which is 1 minus p tilde S1T. Okay. But what is my, see here once you simplify things are looking better. It is u of S naught plus 1 minus p tilde d of S naught. So, that will give me, so S naught will actually get out and cancel. So, it will become here 1 plus r is equal to p tilde u plus d minus p tilde d. So, that would imply that p tilde is equal to 1 plus r minus d divided by u minus d. U minus d is always greater than 0, strictly greater than 0, and 1 plus r is always strictly greater than 0. So, this quantity is strictly greater than 0. Similarly, from here you can now compute out q tilde, which is 1 minus p tilde, which is equal to 1 minus 1 plus r minus d, which gives me u minus d minus 1 minus r plus d divided by u minus d. So, this gives me u minus 1 plus r divided by u minus d, again by the no arbitrage condition. So, it is the no arbitrage condition which is guaranteeing that p tilde is greater than 0. It is a no arbitrage condition which is guaranteeing that q tilde is also strictly greater than 0, and they sum up to 1. So, we can now view them as actually probabilities. But remember, they are not the market probabilities. There is something we have yet not figured out. We have to figure out how much stock I have to buy. That also have to be known by the problem data. That is the beauty of this model, that this just these 3 quantities u, d, r is giving you all the data. So, they behave like probabilities, but they are not the market probabilities. It is not by that probability that this becomes h or tail. P tilde is not the probability of occurrence of h, it is p. We will speak a bit on this, but now let us compute out delta naught. So, delta naught can be computed out. So, to compute delta naught you have to go back to those equations, these 2 equations, and subtract them from each other, and I leave this computation to you to figure out that delta naught is equal to V1H minus V1T divided by S1H minus S1t. It is called the delta hedge of the portfolio. It is called the delta of the portfolio. It means it tells you how much amount of stocks you should, of the shares of the stock you should buy in order to completely replicate the portfolio. P tilde and Q tilde has a very important name. P tilde and Q tilde, they are called the risk neutral probabilities. I will tell you why. Why I am calling P tilde and Q tilde as risk neutral probabilities? What is the reason? They are not the market probability. I would like to remind you that these are not the market probability, which is P and Q, which is the P is the probability of head coming, Q is the probability of tail coming, which is 1 minus P. Not the, this is something you have to, this is not the market probability. Why do people invest in risky assets? Because they want to make a quick buck, right? So they want to be very frank with you guys, I have really never made a investment in the market, but I know friends who have made investment in the market and have lost. So you put your money in risky assets because you want to make a quick buck. So the rate of growth of the risky asset has to be faster than the rate of growth of the fixed deposit, naturally. So if P and Q are real probabilities, then we expect that this should happen. Because if the rate of growth of the risky asset is same as the rate of growth of the risk free asset, then under no circumstances I am going to invest in the risky asset. I will always invest in the risk free asset, the money market. So S naught must strictly be less than this. It cannot be equal to this. The discounted price. So what is this? If you take this P and Q as your probabilities, what is this? It is the expectation of S1, the random variable S1, and you have the discounted expected value. So the discounted expected value of the stock price at time t equal to 0 is this. The stock value of the stock price at t equal to 1 is discounted value for the present value, rather the discounted value is this, and that must definitely be bigger than S0 so that people would actually invest in this stock. Otherwise people will never invest in such a thing, right? That is the idea. So the key issue here is the following, that you would rather invest in a stock because your market probabilities should be such that your expected return or expected money or expected value of the stock should be obviously strictly bigger than the expected price of the stock, worth of the stock, or that discounted value at this present moment should be bigger than S0. Then only I am confident enough to invest in the stock. While the risk neutral probability says, the following. Okay, this is what it says, and it does not say anything. So what does it say? So it says S0 so if we write E tilde is the expectation under the risk neutral probability and this is nothing but the expectation of S1, the random variable S1, the stock price at S1, which has two possible values S1t and S1h, because here the omega, the sample space is h and t, is E tilde is S1, right. So, this is your so this is the expectation under the risk neutral probability. So, risk neutral probability are those probabilities, so the under which the expectation remains, the discounted expectation remains same. Essentially, if you have remember what is the martingale from my last talk, this is exactly the thing. The risk neutral probability makes the discounted value of the stock price, that is here what we can write, S0 is equal to 1 expectation tilde S1 by 1 plus R, the discounted value of the stock price into a martingale. So, that is exactly done. This S0 S1, this process is actually a martingale. So, what it says that under these probabilities my expected return is the same as this. So, why should I invest in the stock market? I can just keep my money in the money market. So, it essentially says the rate of growth of the stock market is same as the rate of the growth of money market. It does not change my money. This is what I can expect. My net worth, my net expected worth of my stock is the same as what is the current price now. So, I would not invest in such a stock. But what are these? Why you use this? Because these quantities allow us to find V0, which is the general P naught Q naught. P and Q won't help us because they would have an inequality and it will be difficult to figure out V naught. It can just allow me to find a bound on V naught. These things come in incomplete markets, but this is exactly what we do in complete market. This study would be done in complete markets. To study incomplete markets, essentially would have a 20-hour course which starts with when you complete market and goes into incomplete market. That's really not a course you give in MOOC. MOOC is to essentially give people ideas and people can then start over and talk about it. Thank you for listening patiently, and now we will go to the next step in our third class, the multi-period models. That if there is more than one period of trading, what is it, right? What is my, how do I price it? You will see always will go at start from the end. We know that what should happen at the end when the trading ends. So, then you can actually when the expiry time of the option, when the trading ends, the last period, and then you can dynamically come back to V0. So, this is exactly a process that one uses in dynamic programming, a very important aspect of modern optimization, whose founder was Richard Bellman, dynamic programming. So, this is exactly the same process that we are using, backward coming down, backward induction sort of thing. Now, that is not a correct word, but it is just a backward process, starting from the very last or what should happen and then coming and see what I should do in the beginning, right. So, we end it here and we will start over with the multi-period binomial model.